Right now, there are people in America who are working extra years, paying thousands of dollars in additional taxes, and doing everything they can to increase their Social Security benefit by even a little bit. And most of them have no idea that the extra money they are pouring into the system is barely adding a few dollars to their monthly check. Some of them are paying almost $5,000 a year in extra taxes just to get $15 more per month from Social Security. That is not a typo. $15. Meanwhile, there are other people who maybe only worked 10 years in their life, who could make one simple move right now and add hundreds of dollars a month to their future Social Security check. The difference between these two groups is not how hard they work or how much they earn. The difference is that one group understands how Social Security is actually calculated and the other group does not. And today, I am going to break this down in a way that nobody has explained to you before, so that you can see exactly where your money goes, how the government decides what you get, and most importantly, what you can actually do right now to put more money in your pocket every single month for the rest of your retirement. Stay with me all the way through this, because near the end, I am going to show you a strategy that most financial advisors do not even talk about, and it could be worth tens of thousands of dollars over your lifetime. So let us get right into this. Before we talk about strategy, you have to understand how your benefit is calculated, because once you see the math, the strategies will make perfect sense. So here is how it works. The government takes every year of your working life where you earned income and paid what is called FICA tax. FICA tax is the employment tax you pay when you have earned income from a job or from self-employment. You pay 6.2% and your employer pays another 6.2%. That is 12.4% total going towards Social Security. Now I need to be very clear about something. That money is not going into some personal account with your name on it. There is no pool of money sitting somewhere that belongs to you. A lot of people believe they are contributing to their own future fund, and that is simply not how it works. It is legally required. You pay it because you have to. Now let us move on to what happens with those earnings. The government looks at your entire working history, and they select your top 35 years of earnings. Not your top 10, not your most recent years, your top 35. And this is where the first big mistake happens. You need 40 quarters of work to even qualify for Social Security. That works out to about 10 years. They call them quarters instead of years because the quarters do not have to be consecutive. But here is the trap. Just because you qualify with 10 years does not mean they calculate your benefit using only those 10 years. They still use 35 years. So if you only worked for 10 years, you have 25 years of zeros in that equation. Those zeros are dragging your entire average down dramatically. Now here is what they do with those 35 years. They do not just add them up and divide. They apply something called indexing. Each year of your earnings gets multiplied by a specific factor that adjusts for inflation and wage growth over time. So let us say you earned $20,000 in 1993. That might seem like a small number today, but back then it was a reasonable income. The government takes that $20,000 and multiplies it by roughly 3, which means in today's calculation, that year counts as $60,000. They do this for every single year in your record. Each year has a different multiplier based on when you were born and when you turned 62. The indexing table for someone turning 62 in 2026 is different from someone who turned 62 in 2020. So now imagine a bar chart of your 35 best earning years. Some bars are tall, some are short, and some might be zero. The government takes all those bars, applies the indexing multipliers, and flattens everything so that every year is measured in today's dollars. Now they are comparing apples to apples. Once they have indexed all 35 years, they add them up, divide by the total number of months in 35 years, which is 420, and that gives you your average indexed monthly earnings. The acronym for this is AIME. Remember that term because it is the foundation of everything. Your AIME is basically your average monthly income over your best 35 working years after adjusting for inflation. Now here is where the government does something very interesting with your AIME. They do not just give you a percentage of it. They run it through what are called bend points. And these bend points are the secret that almost nobody talks about, but they completely change the strategy for how you should think about Social Security. In 2026, the bend points work like this. The first $1,286 of your AIME gets multiplied by 90%. That means for the first $1,286 of your average monthly earnings, you are getting almost dollar for dollar back in your Social Security benefit. That is incredible. But then something dramatic happens. From $1,286 up to $7,749, you only get 32%. That is a massive drop from 90% down to 32%. And then above $7,749, you only get 15%. So think about what this means. The government is essentially saying, we are going to take very good care of lower income earners by giving them 90 cents on the dollar. But as your income goes up, you get less and less benefit for every dollar you earned. And above $7,749 in your monthly average, you are barely getting anything back. The number that comes out of this bend point calculation is called your PIA, which stands for Primary Insurance Amount. Your PIA is the monthly benefit you would receive if you file at your full retirement age. For most people watching this, full retirement age is either 66, 67, or somewhere in between depending on what year you were born, and the maximum amount of earnings that Social Security even counts in any given year is $184,500 in 2026. Anything you earn above that in a single year, you do not pay Social Security tax on it, and it does not count toward your benefit. So that works out to a monthly cap of about $15,275. Now that you understand the math, let me show you why this changes everything about strategy. Let us start with someone who only has 10 years of work history. They have 25 years of zeros pulling their average down. If that person goes back to work even part-time and earns $15,000 to $20,000 a year, they are replacing zeros. Every zero they replace pushes their AIME up. And because their AIME is probably low, most of that increase falls into the 90% bend point. They are getting 90 cents back for every dollar of improvement. That could mean a couple $100 more per month in their Social Security benefit from just a part-time job. Now compare that to someone who has worked 35 years of high income. They are already through the bend points. Their AIME is already high. If they try to push their benefit up, they are only getting 15% on any additional earnings. Let me give you a real example. There was a self-employed person earning about $500,000 a year. Because of their business structure, only $100,000 was classified as earned income subject to FICA tax. The rest was investor or owner income. This person thought about paying themselves an extra $40,000 in earned income so they would hit closer to the Social Security maximum. That extra $40,000 would cost them about $4,800 in additional FICA taxes, because when you are self-employed, you pay both the employee and employer share, which is 12.4%. So the question was, would that $4,800 in extra tax push their Social Security benefit up enough to be worth it? The answer was no. Because they were already deep into the 15% bend point, that $4,800 a year in extra tax only increased their monthly Social Security benefit by about $15. $15 a month. They would have been far better off just investing that $4,800 every year. So the bottom line is this. If you have fewer than 35 years of earnings and you have zeros in your record, going back to work even part-time can dramatically increase your benefit. But if you already have 35 strong earning years, paying extra into the system is almost certainly not worth it. You should invest that money instead. Now, let us talk about the other major way you can influence your Social Security benefit, and that is when you choose to file. The earliest you can file for your own retirement benefit is age 62. The latest age where waiting still increases your benefit is 70. After 70, your benefit stops growing. And I want to be very clear about this because there are people right now who are 71 or 72 years old who have not filed yet because they think their benefit is still growing. It is not. After 70, there is no additional increase. You are just leaving money on the table. Now here is how the age math works using a full retirement age of 67. At 67, you get 100% of your PIA. If you file at 62, you only get 70%. At 63, you get 75%. At 64, it is 80%. At 65, it is 86.7%. At 66, it is 93.3%. And then at 67, you hit the full 100%. Notice that the penalties are steeper in the earlier years. Going from 62 to 63, you gain 5 percentage points. Going from 65 to 66, you only gain 6.6 points. The government has carefully designed this so that filing really early hurts more. Now, if you wait past your full retirement age, you earn delayed retirement credits. These are much simpler. You get an 8% increase for every year you delay past full retirement age. So at 68, you get 108% of your PIA. At 69, you get 116%. And at 70, you get 124%. All of these calculations are done by month, not just by year. So if you file at 64 and 7 months, they calculate the exact percentage for that specific month. Now, there is something that confuses a lot of people, and it is the earnings test. If you file for Social Security before your full retirement age and you continue to earn income from work, the government may take some of your benefit back. In 2026, if you are under full retirement age, for every $2 you earn above $2,040 per month, $1 of your Social Security benefit gets withheld. In the year you reach full retirement age, the rules soften. You can earn up to $5,430 per month, and they only withhold $1 for every $3 over the limit. Now here is the part most people do not know. This is not actually a permanent penalty. The money they withhold gets credited back to you once you reach full retirement age. Your benefit gets recalculated as if you had waited longer to file. So if an entire year of your benefits got withheld because you earned too much, it is as if you delayed filing for that year, and your future monthly benefit goes up accordingly. The problem is not the math. The problem is the surprise. People budget based on getting their full Social Security check plus their earnings, and then they lose the Social Security portion, and they are shocked and angry. It is not that they lost money permanently. It is that they did not plan for the temporary reduction. So if you are going to work and collect Social Security before full retirement age, make sure you understand this rule and budget accordingly. There is one more thing I need you to know, and it involves Medicare. If you file for Social Security before age 65, something happens automatically when you turn 65. You get enrolled in Medicare Part A and Part B. Part A is free for most people. Part B in 2026 costs $202.90 per month, and it gets automatically deducted from your Social Security check. This catches thousands of people off guard every single year. They see their Social Security check suddenly drop by over $200, and they have no idea why. Now, if you are still working at 65 and you have health insurance through your employer, you can turn off Part B and keep your employer coverage. But you have to do this proactively. It does not happen automatically. When you file for Social Security, the application for Medicare is combined with it. There is a notes section at the end of that application, and it is very important that you write specific instructions in that section. You should clearly state that you do not want Part B, that you want to delay Part B, and that you have creditable coverage through your employer. If you have already been enrolled in Part B by accident, you can send back the form that comes with your Medicare card to turn it off. They will send you a new card with only Part A listed. This matters because if you delay Part B without having creditable coverage, you could face a late enrollment penalty of 10%. For every 12 months, you could have had Part B, but did not sign up. That penalty gets added to your premium permanently. So make sure you either sign up on time or have qualifying employer coverage to avoid it. Now here is what I want you to take away from everything we covered today. First, log into the Social Security Administration website at ssa.gov and create your personal My Social Security account if you have not already. Once you are in there, you can see your actual earnings history, your estimated benefit at different ages, and your PIA. The tools they have are solid, and they let you play with different scenarios. Just know that the estimates on the website assume you will keep earning at your current rate until you retire. So if you plan to stop working earlier, your actual benefit may be a little lower than what the website shows. Second, look at how many years of earnings you have. If you have fewer than 35 years, seriously consider whether replacing some of those 0 years could make sense for you. Even part-time work earning $15,000 to $20,000 a year can make a meaningful difference because those dollars are being calculated at the 90% bend point. Third, do not assume that earning more or paying more into Social Security automatically means a bigger benefit. If you are already through the bend points, the return on extra earnings is tiny. You may be far better off investing that money. And fourth, before you make any filing decision, understand the full picture. Know your bend points. Know your AIME. Know what happens if you file early and keep working. Know how Medicare enrollment interacts with your Social Security application. These are not small details. These are decisions that affect every single month of your retirement for the rest of your life. If this information was helpful to you, share this video with someone you care about, a spouse, a sibling, a friend who is getting close to retirement. These are the things nobody teaches us in school, and they are worth tens of thousands of dollars over a lifetime. The link in the description below this video will take you to a free resource where you can download a complete guide covering Social Security strategies, Medicare enrollment rules, and retirement planning essentials. You will also get real-time alerts whenever major rules change so you are never caught off guard. The link is right below. It takes a few seconds and costs you nothing. Now drop a comment and tell me, where are you in this process? Are you trying to figure out when to file? Are you wondering if you should go back to work to replace some zeros? Are you self-employed and trying to figure out how much to pay yourself? Let me know, because your questions shape what gets covered next. Take care of yourselves, and I will see you in the next one.